Thank you. Good morning. Welcome to the New York City Retirement Systems Common Investment Meeting for September 26th, 2016. We are going to start by asking the executive directors of each system to call the rolls. So let's start this morning with NYSERS. Diane? You need your microphone.
Okay, good morning. Chair?
Here.
Controller's Office? Here. Public Advocate's Office?
Present.
Borough President Manhattan?
Here.
Borough President Brooklyn?
Present.
Borough President Queens? Borough President Staten Island?
Present.
Borough President Bronx?
Here.
International Brotherhood of Teamsters? Transport Workers Union?
Here.
District Council 37. We have a quorum.
Thank you very much. Let's move on to teachers. Here.
Thomas Brown.
Here.
David Kazansky.
Here.
Deborah Penny.
Here.
Charlotte Beyer.
Here.
Susanna Vickers.
Here.
We do have a quorum.
Thank you, Patricia. Let's move on to police. Kevin?
It's my big jaw.
Good morning. Representing the PBA.
Joe Rayo. Also have the proxy for Patrick Lynch, Mubarak Abdul-Jabbar, and John Puglisi. Actually, Joe Alejandro has those proxies.
Representing the DEA. SBA.
Bob Ganley, SBA designee for Ed Mullins. Also have the proxy for Lou Turco, LBA, and Roy Richter, CEA.
Mayor's Office.
John Adler, representing Mayor Bill de Blasio.
1 second for the record. Joe Alejandro's in the room. Nature had a higher calling, though.
The Comptroller's Office.
John Dorsett, designee for Comptroller Stringer.
Commissioner of Finance.
John Adler, designee for Commissioner Jacques Jiha.
Okay, and the Police Commissioner.
Rosemary DeBellis.
Okay, we have a quorum.
Thank you, Kevin. Moving on to fire. Lee?
Mr. John Adler?
Here.
Ms. Susanna Vickers?
Here.
Mr. Antonio Rodriguez?
John Adler, present for Antonio. Designee for Antonio, whatever.
Mr. James Levin?
Vince Speciale, proxy for James Slevin.
Vice President of UFA?
We have a new vice president, but right now we're just going with Jim Slevin.
Okay. Mr. Eddie Brown?
Eddie Brown, president.
Mr. John Kelly?
Eddie Brown has a proxy for John Kelly.
Mr. Jack Hilty?
Patrick Dunn, proxy for Jack Kelty.
Mr. John Farina?
Here.
Mr. Paul Furrow?
Here.
Mr. Thomas Phelan?
Here.
Commissioner Douglas White?
Here.
We have a quorum.
Thank you, Lee. And just for the record, let's note that Antonio Rodriguez is here representing Commissioner Jacques Jiha for the Fire Department Pension Fund and also for the Police Pension Fund. Okay, and now BRRS, we want to note your presence. Sandy, you want to take us through?
Mr. Adler, BRRS is represented by Trustee Isaac Harvey-Danny and staff, and any future resolution be resolved at our next regular board meeting on October 19th. Thank you.
Thank you. Okay, I think we're all present and accounted for, and we will turn the meeting now over to Chief Investment Officer Scott Evans.
Thank you, Mr. Adler. And welcome, everybody, to Part 2 of our September SIM. We thank everyone. We know this has been... You can turn me down just a little bit, I think, in the back. Sorry, this is really magnifying. We appreciate, we know there are two big meetings. There's a lot to cover. We had a great meeting last week. This one hopefully will be a little shorter. We're going to talk about the regular quarterly results through June, the fiscal year ending 2016, June 2016, and then the statement of investment principles, which is an important topic for us to talk about. We'll do part of that in public and part of that in executive session, and then you'll hear from several asset classes about implementation plans. Let me turn it over now to Mike Haddad to give you a sense of the macro context for the quarter and also the current period of time. Mike?
Thanks, Scott. Good morning, everyone. I'm going to divide my time with you this morning between two pieces. The first is an overview of the markets in the second quarter, and the second part is on current events. So not that this group is bashful, but I would encourage you to ask any questions along the way, of course, as long as they're fair and good questions. So let me just jump into markets returns in Q2. This is the same format you've seen a few times from me and that I've borrowed from Scott in the past. Third column is the returns by asset class of the second quarter with the index that we use to measure your portfolios with, and the fourth column is the fiscal year-to-date numbers, again for the same categories. And I have two takeaways from this slide. And first is the continued outperformance of U.S. equities relative to developed market equities as well as EM equities, and that trend continued through the second quarter as well as through the entire fiscal year. You're going to hear a little bit later from John Merceburg how some assets are shifting in recognition of this and your asset allocation. The second takeaway from this is the positive results from both fixed income and equities, at least U.S. equities, again, second quarter and fiscal year to date. It brings up a lot of questions as to why. My quick 2 cents on that is the extraordinarily accommodative monetary policy globally. So let me just walk you through a handful of slides on this. I've labeled the second quarter the continuation of the rally with both equities and fixed income positive. And I have three slides here just to pictorially show you the different returns. These are the three major equity indices. The blue highlight is the second quarter, and then it continues on through mid-September. I think they're all pretty self-explanatory. Global government yields continuing in their down in yield trends, with all three major markets, U.S., Germany, and Japanese yields continuing lower in the quarter. And lastly, investment grade and high yield also continuing to rally, following the rally in treasuries with the returns posted below. So this calls into question why the continuation of the rally, and I would argue three reasons behind this. One is the continued accommodative global monetary policy. Two is the reduced concerns about China and their economy, and third, the major event of Q2 was Brexit and the limited impact on financial markets from Brexit. So let me address each of those individually. So speaking of continued monetary policy, let's start with the Fed. This slide graphically represents the change in the amount of tightening the markets were expecting at the end of the first quarter versus the end of the second quarter. And bear in mind, so the second quarter was June 30, so we're still in the Brexit unknown times, but you know it's a picture in time, and on June 30 there was zero tightening expected for the balance of 2016, and only 28 basis points by the end of 18. So those numbers are higher today, but you know, 10 to 15 basis points higher, so not a material change. The second central bank who was very influential in the second quarter was the Bank of England. So the statement on this slide was issued by the Bank of England the morning the markets opened in European time, and it's an extraordinary statement. It says basically we'll do whatever's necessary to support the economy and financial markets. So the logical question is, what did they do, and when did they do it, and what did they do? They moved in early August. They undertook a handful of different moves. First of all, they lowered their policy rate. The policy rate had been at 50 basis points since March of 2009, and they'd held there despite so many European central banks going to negative yields. So they lowered it from 50 to 25. It's the lowest it's been in the 325 years of the history of the Bank of England. So a big deal. Second thing was they increased QE. The third thing is they added corporate bonds to their buy list, and all influential on getting interest rates lower and supporting the UK economy during this massive period of uncertainty. The next source of why markets were so calm in Q2 was the lowering of concerns about China. So this slide shows you a quarterly snapshot of the decline in China GDP over the last few years. And we have to take this at face value like we do with all Chinese economic statistics. But what's important here is in the end of 2015, China's 13th five-year plan was released. And the highlights of that plan included a slowing of GDP, so this is intentional, but a change in composition of it. So where they're targeting GDP in the next five-year period, of which we just started, around 6.5%, and they're trying to rebalance their economy away from the debt-financed and investment in cities and infrastructure towards more consumption. So how are they doing? On the GDP standpoint, they're doing well, again, if we believe their numbers. And on the change in composition, they're doing well. Slight increases in consumption. The one source of concern is in their fixed asset investment. That number of the aggregate is going up at a higher pace than what they forecasted, but the concern is most of it is from public financing and not much from private financing. Which brings me to China credit growth, which has been a big part of why China's economy has remained as strong as it has. So the red line here shows you the aggregate amount of new total social financing in China. The light blue bars show you the increase by month. So the takeaways from this chart are the aggregate increase in 2016, and also the magnitude of the increase versus what was happening in 2015. So this is the good news, bad news for China, and why China is going to remain a source of concern and volatility for markets, is they're doing something similar to what they were doing in 2009 with a tremendous amount of government-financed fiscal projects. But part of the big hard landing concern in China is when this gets turned off, what happens to markets? So the third part of the stability in markets comes from the limited Brexit impact. So let's start first with the currency. Again, the shaded area is the second quarter. The pound fell roughly 7% against the dollar and roughly 6% against the euro. Kind of expected, but not as catastrophic as if we recall those last few days before the vote. There was all these concerns about dramatic impact on the global economy, on the UK economy. How much of that was hyperbole pre-election? Not that we're familiar with that here. But the reality is it's going to take a long time for this exit process to take place. And certainly one of the things that will make it easier will be a weaker currency for the UK's economy. The second slide is the FTSE, so their major stock index, and it was actually up 5% on the quarter. And you can see the volatility in the end part of the month is when the vote took place. But again, up on the quarter, and it continued into the third quarter as well. This slide shows you the drop in yields. I can't remember the exact amount, but if memory serves, it's something like 55 basis points. So a dramatic drop, and that had a lot to do with what the Bank of England said and what the markets were expecting. And the last slide on Brexit impact is the volatility of three major equity markets, the US, the FTSE, and the European market. And you can see the spike in volatility going into the election and then the immediately collapse shortly thereafter. A lot because of what the Bank of England did, and a lot just because the realization that this is going to take a long time to work out. And the other takeaway I would go from this slide is you look into Q3 and you look at the volatility levels in those three major indices, and they're all at year lows. Despite all of the unknowns in front of us, volatility as measured in the equity market is at lows. So before I go to current events, any questions or comments on Q2?
With respect to China, they're pivoting then from an export-driven economy to more to internal consumption, but turning that
So China is pivoting or attempting to pivot from an export-driven economy to one in which internal consumption-driven economy. That aircraft carrier is not going to turn on a dime. So how long do you think that would take? And what is their progress to date? Both what they state their progress is and what it might actually be.
I don't have the answer for that. I was going to say something else, but I didn't want to reference our SEP 21 sim. It's moving the right direction. Consumption is picking up, but they have a lot of structural changes to do within their economy to get there. You know, it's financial services, it's providing health care so people don't save as much, it's providing pensions so people don't save as much. And it's taking place, but it is an aircraft carrier. It's slow. China has a lot of China Inc. has a lot of different facilities to call upon to do it, and you know they've been successful over the past few decades. So I think it's a work in progress.
And the impact on the U.S. economy. I mean, their export-driven economy. Is there still the kind of the manipulation of the currency that we've seen in years past, or they're taking a more foot off the pedal?
Foot off the pedal. The markets and people still focus on the relationship between the dollar and CNY, which is fixed. And that arguably is manipulation of a currency because the dollar floats, so why shouldn't the CNY float? But the nuance that they've done, they also now target their currency to a basket of other currencies, and that basket is trade weighted, roughly to who they export and import from. So the dollar has a slower weight. So if you look at those two charts, you'll see a divergence. Versus the dollar, CNY is weakened. Versus the basket, CNY is strengthened. So it's which one matters more? Today, the relationship between the dollar. Going forward in the 5-year plan, it's versus the basket.
Thank you. I look forward to some nightlight reading on that. Thank you.
This is from kind of earlier slide, looking at the divergence between the kind of U.S. equities and rest of world equities, and particularly thinking about IFA equities. Is the reason for that divergence, or are there is there country divergence as well as far as within IFA? Because looking then at the FTSE 100, it's done better. Wondering what is it kind of all the ships kind of moving in kind of one direction, or has there been divergence that is causing the huge divergence between U.S. and developed market equities?
I don't have the country by country list in my head, but thinking through it, Europe. We can start with the problems in Europe, but they're numerous. So that's been a big component, and obviously Southern Europe has underperformed more than Northern Europe. EM has suffered tremendously, both from their own structural problems as well as the change in China, and they're away from fixed asset growth, which is hurting commodities globally. So those markets have suffered tremendously. Japan is which we'll get to in the current, has gone through it's down hard on the year. So it's a long list that the U.S. has outperformed. I'm trying to think who has outperformed U.S. Maybe India. I don't know. The list is pretty short. And the other thing is we recapitalized our banks a while ago. Our economy has remained stronger than the other economies, despite what feels like a weak recovery. So there's a lot of fundamental reasons behind it. I don't think it's just technical type of things, but the buybacks we have here are just tremendous. So there's a lot of different influences on it.
Other questions for Mike before he moves on? Okay.
So current events. The first two I want to talk about are the policy meetings, monetary policy meetings that took place last week, and I'm going to spend the bulk of my time on the Bank of Japan. This is a difficult one to explain. It was a radical change in policy. and I'm going to try and explain to you what they did and why it matters to financial markets. So they shifted the focus of their quantitative easing from a fixed amount of assets they were buying to targeting interest rate yields, to adding an element of yield curve control, and making an explicit commitment to exceed their inflation target. So in English, what does that mean? So they went from buying 80 trillion yen of assets a year, which is just shy of 800 billion a year, in the fixed income market in government bonds, and they let the prices fluctuate. So every month they routinely bought the same amount and the same parts of the yield curve every single month. You know, we could argue it's not working, they're running out of bonds. There's a host of reasons why they changed, but they changed. So what are they doing now? They are, the 10-year point of the yield curve, they are targeting at or around 0 basis points. That's number one. And they're going to let the supply that's required float to do that. The second thing, the yield curve control. They're going to buy less 30 and 40-year debt and more shorter-term debt in order to influence long rates higher, very long rates. And I'll get back to that in a second. The third thing they do is they've made an explicit commitment to exceed their 2% inflation target. And we can say, who cares? They haven't had 2% inflation in, I don't know, 40 years or something. So let me start first with the yield targeting. So the 10-year note in Japan currently this morning is minus 6 basis points. Its low in August was minus 30. 2 weeks ago it got up to all the way up to 0. So now they're going to try and keep it right around 0, plus or minus a little bit. And how they're going to do that, and I won't go into the minutia of that, but it's an important component of what they're trying to do. So they're going to let their balance sheet fluctuate, the size of it fluctuate, but they're going to try and keep the 10-year note right around 0. The yield curve control, this is an important signaling device. The Japan Inc., the government side, the monetary policy side, has recognized there's implications to the economy of too low of long-term rates. So I'd point to 3 different places. Bank profitability. The simple bank model is borrow short, lend long. So low long-term rates hurt a bank's profitability. And in Japan, that's where the extension of credit comes from. So they've made that recognition. The second one is on the health of insurance companies. And third, on the impact on pension funds, which I think in this room we all feel acutely. So it's important what they're doing for Japanese assets, but it's also a signal that the rest of the world may or may not be on board for that theme. So this is this merits a keen attention. The third part, the commitment to a 2% inflation exceeding it. So this gets into a few different elements. It's the time required. So typically QE programs have an end date. The ECB is supposed to end in March of 17. You know, the Fed, we had that whole taper thing in 14. So Japan is not putting a time calendar base, they're doing a objective base. So this could go on as long as it takes. If it takes 40 years, it'll take 40 years. So this is an important commitment. And the second part of it is, in a positive scenario for Japan, as they're approaching that target, they're not going to let off. They want to not only match it, they want to exceed it for a period of time. So very, very powerful statements from Japan. And away from the impact on yen-based assets, to me, it's a. We have to bear in mind Japan was the first country into deflation. They face arguably the worst demographics in developed markets, and what they're doing to get out of it could be a template for how the rest of the world deals with this going forward. You know, England has its host of problems with Brexit. Europe, let's not even go there. But developed countries have followed Japan's policies into the similar type of problem. So this could be a template for how other countries deal with their deflationary problems and slow growth going forward.
Yeah, what is Japan's current inflation rate or deflation rate, as the case may be? You know?
I mean, headline is, so bear in mind inflation is lagging. Inflation by its own merits is lagging. It's reported on a 12-month basis, which also is lagging. Headline inflation, if memory serves, is 0.7, and core inflation is closer to 1. And think about what's changed since then. The yen's gone from 120 to 100, so that's going to add deflation. All things being equal, that's going to add deflationary pressures to Japan. The second policy meeting was the Fed. They strongly signaled they're going to raise rates in December. It begs the question, why didn't they move at this meeting, given the language in their statement? the Fed has been very, 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 very slow to move off of its emergency settings. And the one other element I would add is similar to the unknowns regarding Brexit is the unknowns of our election going forward. Enough said on that one. The other thing they did, they signaled a slower pace and a lower terminal rate, and all things being equal, that would argue for a lower long rates in our country. But I would say that the markets are very, very, very far ahead in their dovishness relative to where the Fed is. So, for example, the funds rate 10 years forward, which is what the markets are priced for, it's priced for a 1.5% funds rate, which is really remarkable given the Fed's inflation target is 2. That's a negative real rate 10 years forward, and that the markets are forecasting for our economy. So it tells you how richly valued long rates are in our country. And that gets, I don't think I tied well enough into the first point. That gets back to the correlations between interest rates amongst developed market countries. So whatever happens to Japan happens, it's idiosyncratic to that country, but it also is highly correlated to what goes on in interest rates globally. And I would argue that a lot of the reason our rates are so low is what's happening in foreign economies. So the election, future events, the election, tonight is tonight. It's really hard not to say much on it.
Go ahead. Give us your prognostication.
The other thing I'll say is if you go back to a few of those Brexit slides, the volatility in Brexit didn't happen until the last 2 weeks. The event was well for it. We knew well in advance it was coming. We know well in advance what day our election is. And I'm kind of wondering if the volatility is going to come closer to the end of the election. I don't know. I'm looking forward to tonight. The last point, which I think is an extraordinarily important one, this is the potential for the increase in fiscal policy globally. There's been a lot written about this by academics, by past policymakers, and why it's so important. And if you think about this, since the crisis, monetary policy has been the sole driver between monetary and fiscal on supporting the economy. We've arguably reached our limits in monetary policy. The change in Japan had something to do with their ability to buy more government bonds. They're running out of government bonds. Germany is running out of government bonds to sell to the ECB. So what would be that change? Do they just give up? They're not going to give up. But there's more and more calls for fiscal policy to expand. And if you look back at different graphs, fiscal policy was actually contractionary for much of the post-global financial crisis. In our country, 2013 was the peak, and just go back a few years, and it was all about deficit control and getting debt sustainability ratios in place. Our debt to GDP went from 9% to 3%, so we've accomplished a lot. So there's room for fiscal policy to expand, and the implications on markets is extraordinarily important. And there's a few questions that one has to resolve before you come to any decision. Is how is it financed? Is it financed through higher deficits, or is it financed directly through monetary policy? The other term that's thrown around for that second option is helicopter money. We haven't gotten there yet anywhere, even in Japan. So that's an important variable to watch going forward. And the second unknown is how central banks will react to an increase in fiscal policy. Will they accommodate it? Will they tighten early in anticipation of the change? Again, very important concept for us to keep close on. But this is what we're watching. This is what we're focused on at BAM and with our advice to you on your portfolios.
Any more questions for Mike? Yeah, go ahead.
Please tell me if this will be more covered in, the executive session. But do you have kind of with these kind of events? Do you have any kind of ideas about as far as like timing or implementation, or will that be covered in the executive session?
Executive, but it's. I think the fiscal policy is the huge one, and broadly speaking, it's supposed to be bullish for equities, bearish for bonds. It's not that simple though for a few of the things that I brought up, but. I think this is one of the reasons we want some flexibility in tactical tilts, particularly in fixed income. If there's a radical shift to fiscal policy and it's financed via the monetary authority, rates are going up and curves are going to be steeper. And we have no intention to sit passively through that process.
But our specific thinking about how we would navigate this would be appropriate for executive session.
I have one more question, a macro question, which probably isn't fair to ask or for you to answer. But in this morning's New York Times, folks may have seen the headline that the poverty rate in the United States went down the most it's gone down since 1999. I think 3.5 million Americans came out of the poverty, came above the poverty level. I have both a cause and effect question in terms of, monetary policy. So let me just say, can you comment on what you think the cause is, or to the extent that monetary policy influences that, and what effect will the increase, essentially the increase in wages, which is also part of the Fed's mandate in addition to inflation, have on monetary policy?
I would argue since the crisis, monetary policy has worked to increase the income inequality. Its boost on the economy has been marginal in comparison to the boost in financial markets, and I think that's been a big driver of the income inequality. That being said, it has helped the economy. It hasn't hurt it. It certainly has been helpful to raising the bar for all Americans. Their mandate is maximal sustainable employment growth with stable inflation. Wages are part of the inflation, but I think the wage component came more from pressure on corporate America to make things better. So I think that's more part of it. And your point on the Times article is excellent, but the level of poverty is still extraordinarily high in the country, and I think fiscal policy addresses that more than global policy. Monetary policy is a blunt tool. It influences financial markets, which are supposed to influence the economy. So if I'm Yellen, I'm thinking about the correlation coefficient between financial conditions and the economy, and it's not what I thought it was when I started all this in 2009. So that's part of the cry for fiscal policy.
Oh, sorry, Ray, go ahead.
Mike, if the deficit is only 3% of GDP, that's a tremendous drop. Does that argue that there's a lot of slack in the economy to do, for example, looking, say, 6 months out, a new administration, whoever it is, to do a very robust infrastructure program? I mean, are the conditions, or not whether it's going to happen or not, but are the conditions ripe where it could be considered?
100%. You know this as well as anyone. The president doesn't enact changes in fiscal policy. Congress does. It takes the two bodies working together to do so. And the last 8 years has been this, not this. So whatever the outcome is on November 8th, it's not just the presidential election. It's who controls the House and the Senate, and the willingness of those parties to work together. So the conditions are ripe. There is no better time to borrow long at these rates and to invest in a poorly conditioned infrastructure that we have, as well as some targeted tax cuts or direct money to those who are in need of it.
Thank you.
Thanks very much, Mike.
Yeah, thank you.
Sorry, just a quick point of order, Mike. I appreciate the presentation, but I had asked in the past, anytime there are any type of slides being presented at the meeting, that the trustees have copies of them.
Done.
And that's just not you. I think any slides that have been presented. So I asked for Friday slides that Alex had put up there. They had some seminal information in there that would be beneficial possibly to making a decision on the investment. I still don't have them as of today, so I'd like them before the end of the meeting. And Scott, if you could remember that in the future, whether it's inconsequential in your thought or not, the trustees should have copies of the slides.
Absolutely, Joe. And when you put in that request, I asked my staff to provide the slides to all trustees. So it's done. Okay, John, you can make that happen. Okay, so the good news is I I can sleep well at night because we have a world-class macro thinker in Mike Haddad working for the city workers. The bad news is he's so interesting that we're already behind. So I'm going to try to pick up the pace a little bit as we talk about the performance of the pension fund during the second quarter. And we have our familiar look at things. I array the 5 systems. I order them by the riskiness of the portfolio as measured by a portfolio standard deviation. This is the 1-year standard deviation. And as is always the case, BRRRR has got a more risky portfolio, more growth assets in it than the other systems, which are similar to each other. And so that's arrayed in that manner. In the second quarter, everybody turned out about the same, right around 2%. In fact, a little better than the median fund is measured by the Tux Universe, and that measures all large institutional portfolios, including pension funds, endowments, sovereign wealth funds, etc. So a little better during the second quarter. Fiscal year to date, we're right around 1.5% on average. BRRRR was less. Why was BRRRR less? 21% of BRRRR's portfolio is in international equities. International equities, as Mike showed you, were down 10%. Whereas bonds and U.S. equities were up. And that difference represented most of the difference in the two. On a 3-year basis, it hasn't made a big difference, right around 7.5%, 7.2 to 7.5, and better than the 3-year results for the Tux Universe. 5-year numbers right around that 7% number that we work for over a long time period. We've said to you in the past, we'll say to you again, we think it was easier in the rearview mirror to make 7% than it will be over the next 5 years. But when we assume rate of return, and the actuary does this work, she's looking over a 30-year period. And so while the next 4 or 5 years may look like they'll be less than 7%, over a 30-year period, it still looks like that's a reasonable return. These are long-term portfolios, long-term liabilities. And so we're very much in the game and on track. I will just point out to you and remind you, up at the top panel, you can see the page for each of you that each slide is in. So Joe, all of these slides refer to pages in your deck. Should you want a copy of the summary deck, I'd be pleased to provide it for you, but there's nothing on here that's not in your deck. And your mileage may vary. The Fires report is a little different than the BRRRR report, etc. Okay. Let's take a look at the footings of the portfolio, the asset allocations relative to target at the end of June. These are the old allocations that you had before the recent changes. As you can see, right at the end of the quarter, we're a little overweight in U.S. equities and underweight in international equities, most notably developed markets. That's not surprising given the performance of the portfolio. We rebalance periodically to keep us on track, and we have in fact been working on that. The rest of the equities pretty much on track with the long-term targets. We look at fixed income, you see a familiar sight. We have a tactical leaning against Core Plus 5 bonds relative to target, and we're overweight shorter term bonds around 2 years in duration. That has been the case for much of the last 2 years, and we've talked at length in our asset allocation about how we plan to change that. The total portfolio, first we'll look at the benchmark, and the benchmark was right around 2%. This is the strategic policy, the old strategic policy, and BRRRR was less, even their benchmark was less, and that's because their policy was to have much more exposed to international equities than is the case in the other systems. Relative, and then the portfolios did here, they look very much like the policy, and then the relative, one minus the other, is over on the right. So we underperformed the policy benchmark modestly during fiscal 2016 across the systems, with police and fire a little bit softer than the others, and it's well within the 100 basis point level. If we want to look at this and break it down further, This is the total excess return here. I'll break it down into asset allocation, how we're looking relative to our long-term policy mix, and then manager value added. You can see that we were right on our target for asset allocation, not surprisingly, since we're rebalancers. But the difference, positive or negative, came from manager value added. I'm going to focus the rest of my presentation, as I've done in the past, on manager value added. But unlike the last time, I'm not going to go through every component piece. I'm just going to go through the pieces where there was something interesting going on, positive or negative. We'll start with the comparison of this year to last year. We were under the benchmark slightly this year and last year. The system, components were a little different versus last year, but it's pretty much a similar picture. When we look at equities, we can see that equities were similar but a little bit worse. And equities were really the part of the portfolio that dragged us under the benchmark. So I'm going to dig into equities in detail to help you understand the pluses and the minuses. It wasn't all negative. We'll start with the positive. We actually had a good fiscal year, this is the whole fiscal year, in small cap equities in all systems. BRRS is very close to the benchmark because BRRS is mostly passive in small cap equities. The others are active, and they had a good year versus an off year last year. So 2016 was a positive. That's the positive. The rest you're going to see is why we dragged ourselves negative. We start in mid cap. You can see that teachers and NICERs are pretty close to the benchmark in mid-cap because they have indexed exposures in mid-cap. We have active managers in police and fire, and there were poor results in 2 active managers. BRRS didn't have the worst one. BRRS tends to be focused on just one manager in a spot. There were 2 managers that had off performance, and BRRS had the better of the 2, but they still had negative performance. You can see over here, it may help to scale the importance. This is the weight of the sector we're looking at in the whole portfolio. So we're looking at 2 to 3% of the portfolio here in the U.S. equities mid-cap. We're drilling in to understand why equities were soft. Emerging manager program. Problematic. Problematic last year, problematic this year, big time. And NICERs and BRRS had much worse results than the other systems, which were also negative. The main reason there is that NICERs and BRRS have Russell 3000 mandates, whereas the others have Russell 2000 mandates. And as we talked about the RFP that we're doing for emerging managers, we think the chances are much high in the small cap and international mandates, and that's where we're going to focus. We are restructuring this program. It has had poor results, and we're restructuring it so that it will have a better chance of adding value and be focused more on what the program was designed for, which was to scout great managers out there in the emerging market universe and bring them to our attention so that we can underwrite them and make direct allocations. So this, we're already on the case on this, and you have already approved a scope for the RFP, and the RFP is in fact out there. International equities, a mixed picture, mostly positive. We can break it into developed and emerging and look at growth managers first. Growth managers were a little soft during the quarter. One IFA manager was strong, one was weak. BRRS was exposed to the weak manager. So you can see how being diversified can help or hurt you. BRRS is less diversified. That's their philosophy, and that's how they've been structured. And when things are working, it works positive for them. But generally, things were a little soft on the growth side. The value side was universally positive. We have, across the board, the value managers in IFA were doing very well during the quarter. A big improvement from last year. In the small cap, same thing. We have developed small cap was positive across the systems, and in emerging markets, we were soft during the quarter, worse than last year. Here, it's a little complicated. The results were similar before you consider the benchmark. Teachers and NYSERS have a custom benchmark. Their benchmark actually did better than the unconstrained benchmark with which the uniforms have, and so the relative results were softer for NYSERS and teachers, if that makes sense. On fixed income, I'm going to go through pretty quickly. Not much to talk about here, but it is a large part of the portfolio. Modestly negative during the period of time. Enhanced yield, modestly negative. BRRRR's a little bit more exposed to one of the weak managers. Again, well under 200 basis points of underperformance. Bank loans were modestly positive during the fiscal year. And ETI, let's not forget, it's unfortunately still very, very small. ETI turned in a terrific year. Why was the year so terrific? Because we compare it to a benchmark that has a much shorter duration. We don't really have a good benchmark that has a similarly long duration. So in bonds, particularly long duration bonds, are doing well. ETI is going to show very positively. It's had a solid track record, but it's amplified by the different durations in the benchmark Fannie Mae portfolio. Hedge funds, controversial asset class. The orange NYSERS has decided to exit this asset class. Modestly negative last year, modestly positive this year relative to benchmark performance. That is it for the funds that we look at on a time-weighted return basis. We look at the funds that we've just talked about on a time-weighted return basis because you decide when you give them money. And it's not fair to judge them based on when you decide to put money in or take it out. So we take out the effects of cash flows, that is the standard in the industry, and look at time-weighted returns. Different thing in the private asset classes where the manager decides when they're going to draw down the money. And because the manager's deciding that, we have to hold them accountable for whether they're doing a good job on their timing or not. And we look at dollar-weighted returns, which does not take out the effect of the timing of the cash flows. And here, we look cumulatively. It's a long-term game, and you get a lot of noise when you look at short-term results. We look at the difference in the IRR, the dollar-weighted return, for the funds in aggregate versus what we would have done if we just invested in the public markets during that same period of time, known as the PME, the public market equivalent. More on that later. The good news is that 3 of our 5 systems now, most of them in place since 1999. BRRRR's is more recent. They're in a positive territory. We're making more money than we would have made if we just left the money in the Russell 3000 in the case. That's good news. It's not great news. It's great news when we get above this bar, which is 300 basis points. That's what we think we should get for the illiquidity, tying up our money, and the fact that these funds are more highly levered. The companies in them are more highly levered. We think that excess return really doesn't happen until 300 basis points over the benchmark. So good, but not great. Same thing in opportunistic fixed income. We used to measure this versus a 10% flat benchmark. We're now looking at the high yield market because those are like vehicles, and we want that same 300 basis points over the high yield market for the same reasons. We've been just about a push with that. That's not what we're looking for. So we're trying to do better in OFI. David,
Scott,
you had a question.
I'm sorry. I just want clarification. Are the numbers that we're seeing, are these gross of fees or net of fees?
These are all net of fees.
Okay.
All the numbers that I've shown you on the short-term results have been net of fees.
Okay, that's what I thought.
Prior to 1/1/14 for public market securities, it's gross of fees, right? So the fiscal year results are all after that, so everything's net of fees. Okay. And the private markets have always been net of fees. OFI just covered. In the private real estate, I've broken it into core and opportunistic for you. That's the way we're doing the asset allocations. I thought it would be helpful to look at this. We're struggling in all but one system to get up above a break-even with the PME and real estate core. Notice how much better BRRRR's is doing. One of the principal reasons for this is BRRRRs didn't start until 2010. As you know, we changed our underwriting process and standards. My predecessor began that. It's a very positive thing. And we also had the global financial crisis before that. And the combination of those two things have led to the struggle. All the funds have done well, since that 2010 period. But on a cumulative basis, you've got the other funds still being held down. But they're close to zero, and we're hoping that they peak up above their benchmark. Real estate non-core. I should mention that the PMEs are different here. The PME for core is 40% equities and 60% bonds. In non-core, it's the reverse, 60% equity, 40% bonds. So they've got different benchmarks as to whether or not we're adding value. That's a better story. Some of the same phenomena with BRRRRs. You can see the teachers non-core is up in the 400 basis points relative to benchmark over time, which is a decent showing. Infrastructure is the star of our show. It's unfortunately very, very small and very young. Just started in 2013, but it's come out of the gates in terrific shape, and on a PME basis, adding well over 600 basis points in all asset classes. So there you have it. That's the look at the fiscal 2016 results. I'll take any question on that before I go to the statement of investment principles.
Dave? Sorry.
So, some systems seem to be moving more towards a completely passive strategy. And so, looking at what we've seen, especially in the public markets, that the value that an active manager is supposed to be adding is rarely actually being added, and to the fact that we pay them a fee to underperform, as it seems. Do we think that are we expecting them to come around? Is this a strategy that we should be reevaluating as we move forward?
I promise that was not a setup. Thank you, David. Excellent question.
Well, then I retract the question.
As you find as we go through the statement of investment principles, we agree with you. It's tough to make money in active investment in the public equity markets, particularly in the United States. Very tough. And so when we look at the ambition that we have, how much of the portfolio do we think it's possible to put into active investing? It's less than we see in the international areas. And when we look at the performance objectives that we're going to have and the way that we structure our contracts, we're in favor of more performance-based fees in public equities, where we pay a very low fixed fee, almost like an indexed fee. It'd be a little higher than an indexed fee, but where most of the money that the manager is going to make, they'll only make if they exceed the relevant benchmark, if they're bringing excess return. And we think in the case of public equities, that we ought to be able to retain about 75% of that excess return for the participants in the plan. So that's built into our guidelines, which I'm about to cover. So thank you for the question. Other questions?
Tony, looking at kind of the value add per managers and just kind of eyeballing it, it seemed as if in many cases markets that were down were the ones where we had value added. And that's just from anecdotally. Is that actually you all's experience at BAM that we've had better performance from our active managers in down markets than in up markets?
Not always, Antonio, but you do have a situation with value managers in particular. They tend to run a lower beta even than their benchmarks, and so they end up doing well. But I think it varies over time. One of the managers that did quite well during the period of time, we're in public session, so I'm not mentioning specific managers. Actually, is a high beta growth manager that does well in up markets, and they still managed to do well in this period of time where there was very modest growth in markets.
Any other questions for Scott?
Okay. At the moment? Thanks very much. Let's move on then to the statement of investment principles. So what is this? This is our attempt to put in front of you what we believe to be our instructions from you on how we should allocate the strategic allocation that you voted on at the last meeting. We have broken it down into objectives, philosophy, the actual strategic allocation policy, the roles and responsibilities, and we focus just on your role and responsibility, which is basically to approve and send us in the direction of how we ought to allocate these allocations. I'll go over that. And ours, our responsibility, where is the line between the two of those? Talk a bit about risk management, what our reporting standards are going to be to you, and then get into the asset class strategies. I'm not going to go over the whole thing. It's in your book. We basically assembled all the pieces of the larger investment policy statements and put them in one place in sort of a crystallized version, so that anything that was in the investment policy statement that referred to our allocation of the assets and how we go about implementing your instructions is in this document, and that's the objective of the document. Any questions about what the document is before I move on? Okay, I'm going to hit the highlights. The objective is motherhood and apple pie. We want to grow the assets using prudent practices in a way that's sufficient to meet our current and future benefit obligations, net of fund expenses, net of all fund expenses. And that is the mission of any large institutional portfolio. We also, in the way that we risk reduce, we want to limit the severity of potential asset drawdowns. This will minimize the effect of any market-driven moves in the annual contribution to the fund. We tested this when we went through the early parts of our asset allocation discussion together, where we looked at different allocations and we said, if we did these allocations, 10,000 times, what would the worst 5% look like, and how much of a bump in annual contributions would that result? That is exactly what we're testing here. We want to limit the severity relative to your own risk preferences, and every board's risk preference is a little different. I talk frequently about BRRS and how BRRS has a little bit higher risk tolerance than the other systems do. But these twin things drive everything. In terms of the philosophy, what philosophy do we use to do this? The first one is pretty straightforward, and most pension funds have this. We want to diversify. Okay, diversify by asset classes, by geographic exposure, and the risk management team is going to help us look at all different ways of looking at these risks. The second one, you can do a couple of ways. And in fact, over time, your investment office here at BAM has used different philosophies. I want to sort of memorialize our philosophy, which is that our game is regular rebalancing. That you give us a strategic asset allocation, that's what we're going to put together. We'll stay right near that strategic asset allocation unless we have a very, very good reason. And if we have a good reason, otherwise known as a tactical bet, it'll be rare, it'll be fully disclosed to the board. Every time I've gone in front of you over these past months, I've talked about the fact that we've underweighted core plus 5 fixed income and overweighted shorter term fixed income. That's the only tactical leaning that we have in the portfolio. If we have any in the future, that's the way we'll handle it. The mayor's office has suggested that we take it one step further and report to you, and I'll get into reporting in a little bit, which is what exactly has been the effect of this tactical bet, and we will do that. It's an excellent recommendation. So that's rebalancing. The second is something that has grown up sort of cumulatively, and I think it's time to memorialize it. You each have, over time, developed different investable universes, even, let's say, within the Russell 3000. I can't invest in the whole Russell 3000 in teachers or in BRRS, even in police or fire, because you've excluded certain companies for various reasons, and they either didn't meet the ESG guidelines broadly defined, responsible contracting policies, or some other reason that they should be excluded from the portfolio. Internationally, There's a different way of looking at China. For instance, China, as I mentioned in my talk earlier, it's not in the benchmark for teachers and NYSERS. It is in the benchmark for police and fire. So each have different customized investable universes. We want to memorialize that. We want to look at the difference in performance over time between your investable universe and the unconstrained universe, and monitor that when we're looking at performance. And when we look at new additions to the exclusion list, it'll shrink the investable universe. We want to test the cumulative impact of that on the portfolio. So when I know there's discussions about additional changes to the investable universe, we want to memorialize what that total effect would be. And this is one of the things. There's been some discomfort that we do the same thing for every board. This is not done the same. Police and fire have a different philosophy about investable universe than teachers and NYSERS, and we have to respect that, and we have to have one system to monitor it and to structure the portfolio over time. So I'm suggesting that we memorialize that process. The investment management contracts. This is something that's been a major theme of ours. It has been a major theme of some of the boards, not all of the boards, and that is that we absolutely need to tighten our investment contracts to focus on our managers getting paid when they add excess return to the benefits of our participants. And we need to set the terms so that we expect a large majority of that excess return to accrue to the benefit of fund participants rather than the managers. We're doing this in the active equity space. We're doing this in the active fixed income space. And we spent a whole day talking about doing it in the private markets space together. So this is a philosophy that we want to implement, and we want to memorialize with our philosophy. The last thing is a value that's shared across all the systems, and that is through our emerging manager programs and through the diversity lens that we use when we underwrite our portfolios. We should make every effort to employ managers who practice diversity in their staffing, and this includes minority and women-owned enterprises. This is important enough that it should be in the very fabric of our philosophy as a firm. This doesn't mean that we exclude a manager because they're not minority and women-owned, or exclude a manager because they're not a high practitioner of diversity, but we consider it a negative when we're looking at the overall underwriting. It's part of the fabric. So when we look at asset allocation, we're recommending that we break it down into three pieces. And this is important. The first piece, the reference allocation, this is something that we talked about in our asset allocation work together, but we haven't formalized in our reporting to you. And we think it's high time that we did. There's been a lot of discussion, and I've gotten a feeling that the board is comfortable with this. The reference allocation answers the following question. If we just took the money in the pension systems and invested them in two assets, index stocks and index bonds, in a 65-35% mix, how would we do? Because we know that is likely to produce reasonable results over time. We've tested it through many periods of time, and it's a perfectly respectable way to invest pension funds' money. We could simplify our operations tremendously by adopting this simple policy. Your BAM staff could be smaller, our meetings could be smaller and quicker. We could get this done very quickly. However, it's riskier. And we considered it. Every one of the boards took a look at it as a potential option, and we decided it's riskier. We want to have some protection. We don't like the drawdowns that are accompanied by it. So what we want to do is we want to adopt a more sophisticated strategic allocation that's going to best achieve our objectives. But we ought to keep track of how that strategic allocation is doing versus this simple reference allocation. So we'll do that when we break apart performance. We'll break those. and show you the component pieces. Now, we also think it's important to get into the documents the need to reevaluate the asset allocation frequently, at least every 3 years, in order to ensure that the fund objectives are being made. We said at the end of this last allocation, because of the uncertain world we live in, we think it's more like 2 years, 18 months to 2 years this time. But normally it would be 3 years. Reporting, and this is important. This is us feeding back to you what we think the instructions are from you. You want us to include this attribution analysis every time we get together. We get together quarterly in meetings such as this. Purposeful differences from the asset allocation will be reviewed at the board at every SIM, and the impacts be measured and shown to you. Value-added analysis will attempt to identify the percentage of manager gross returns that are being retained by the systems. I will tell you, I can do this today in active. I'm working hard to be able to do it. I'm sorry, in public. I'm working hard to do it in private. I need some more software tools and one more vendor in order to make it happen on the private side. We've worked with our current custodian, and we need another tool in order to make it happen. We've gotten all the data in now, but that's going to be the bottom line for us as we go forward, and we'll report that to you regularly when we have the data. And when we talk to you, as we're doing today quarterly, we'll highlight the important differences. We won't go through every piece of the portfolio. We'll just highlight the unusual results. This last one I pulled out because I'm recommending something that's the same for some boards but new for others, and this is for discussion. But the idea would be that for new managers, we would bring them to the board and bring the manager here to present to you. For re-up managers, we wouldn't have them come and make a presentation to you unless you specifically requested it, and that would be our proposal for having things move more smoothly. You wouldn't give up any opportunity. If one board wanted to see the manager, you could still ask for it. But the standard and customary practice would be new managers have to present to the board. Re-up managers, BAM will present to the board, but the managers will come only if they're requested to do so.
Scott, that's public and private assets?
Yes. Yes. Okay, that is the end of the public portion of my presentation to you. So let me stop and ask if there are any questions on this before we go to the executive session.
Mr. Schimmel.
Thank you, Scott. Thank you very much. And first, I know we're in public session, so limited to what we say on certain managers. But I would want to first of all thank the Bureau of Asset Management. This is, we're in public session, and I think part of the attacks on defined benefit plans is this understanding that no one in the country is making their 7% or their actuarials, and though it is going to be harder, the numbers here, 3 and 5, clearly show that that's happening. And with tightening of processes, hopefully that'll continue, even though it's, as you said, long term. Is the goal.
Larry, could you speak up a little bit? We can't hear you down here.
Sorry. Yeah. The better. So, the one question I did have is that you correctly said it, and thank you for recognizing that each of these boards have different investment philosophies. A lot of us on several boards have talked about doing investment beliefs also as a concept that some systems in the country are doing, and that may be something we as a board and with BAM talk about. But one of the things you mentioned is that you'll compare that to, I guess in essence, a reference type benchmarks to see where those values add or detract. And I think the thing we have to stay focused on, though, is some of us, and I know teachers and NICERs and others, have some of these investment beliefs, because we believe they, just like the returns are a long-term, 30-year type benchmark, so too some of these long-term values and long-term beliefs also take a period of time. Right. So I just want to make sure that when you're thinking about this, that you're not just going to compare a short-term reaction to a whether it's an investment or a country screen, because it doesn't measure up, and I think we just have to be cognizant of that.
Thank you, Larry. And I think Larry brings up a good point. Our initial performance presentations at the SIM have been focused on pretty short-term numbers, and I think we're rightly criticized for not putting some longer-term numbers in there when we evaluate things, and I think we'll endeavor to do that. Any other questions before we go to executive session?
Real quick, Scott, how much of this document is actually referred to in the administrative code? So I just want to know, language-wise, how much of this was actually pulled out of the administrative code? Is it just us making this document up and giving you authority or more delegated authority from the boards?
Yeah. I don't necessarily have the answer on administrative code. Maybe one of my staff could help me, but I can tell you how it was constructed. We took a blank sheet of paper and looked at all of these issues that I've just gone through, and then we looked at the investment policy statements of all the systems throughout all the time. As you know, these have become very complex documents, and we looked for places that there were issues. I've tried to highlight them here. We talked to each one of the 5 consultants and had them go through it to raise any issues with them. And what you have in front of you is what we believe is a distilled version of all the aspects that are in the investment policy statement that would directly relate to asset allocation and how to implement asset allocation. It is not by any means an inclusive statement of everything that's in the investment policy statement. That's why we very consciously did not call it the investment policy statement. There are all kinds of governance issues, responsible contractor policies, et cetera, et cetera. And so this is just a statement in one place of everything that relates to asset allocation, and we would adopt it as part of the investment policy statement going forward.
So to the extent that there is any disagreement between the investment policy statement and this principal statement, you're going to follow the policy statement?
Sure. So what we should do is we should talk about it if there are any places that they're bumping up against each other. And this is our attempt. This is my attempt to put in front of you my instructions from you as I understand them. And there are a couple of things that I'm suggesting that we might do differently, which I've tried to highlight here. But these are really your statement of investment principles, your instructions to us, and I served them up so that we could have a discussion about them. But if they don't meet what you believe to be our instructions, now's the time for us to adjust them. And if they need to be adjusted a little bit differently at police than at NYSERS, then we should absolutely do so. So this is my attempt to get the discussion going and to use our staff to sort of pull everything together in a concerted fashion.
I'll reserve the rest of my questions for executive.
Okay. Other questions? Good. Let's move to executive session then.
Yeah, Mr. Adler, before we go in, I just want to note the slides from the 9/21 CIM, which Mr. Alejandro requested, were sent to the entire board, and they should be in everyone's inbox right now. So, thank you.
And I'd also like the slides that Scott referred to before, the overall slides that would refer to the 5 boards also.
And we will also send those as well. Thank you.
Okay, is there any other business for public session at this time? All right, so then motions to move into executive session by each of the boards would now be in order. So let's start with NYSERS. Is there a motion to move into executive session?
So moved.
Is there a second? Okay, motion made and seconded. Any discussion? All in favor of moving the NYSERS meeting into executive session, please say aye. Aye. Any opposed? Nay. Any abstentions? Okay, motion carries. Next, let's do teachers. Is there a motion from the Teachers Board to move into executive session?
So moved.
Is there a second?
Second.
Okay, motion made and seconded. Any discussion? All in favor of the motion from the Teachers Board to move into executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Let's move to police. Is there a motion from the Police Board to move into executive session?
Motion to go into executive session.
Thank you. Is there a second?
Second.
Motion made and seconded. Any discussion? All in favor of the motion to move into executive session for the Police Board, please say aye.
Aye.
Any opposed? Nay? Any abstentions? Okay, motion carries. Fire. Is there a motion to move into executive session for the Fire Board?
So moved.
Is there a second?
Second.
There's many seconds. Any discussion? All in favor of the motion to move into executive session for fire, please say aye.
Aye.
And all opposed, please say nay. Any abstentions? Okay, the motion carries. All those boards are now in executive session. Let's turn the cameras off.
Cameras are on.
All right. Can we give a report out on what happened in executive session, please?
Okay, the Police Pension Fund heard presentations on asset class implementation plans. Both of those plans were tabled. We also, on a previous date, heard discussions on excuse me, on some asset classes. Those were all tabled, and we heard some discussions on hedge funds, and they were also tabled.
Thank you. Now,
Given that, I'd like to make a motion to adjourn.
all right. Is there a second?
Second.
All right. All those in favor, please say aye.
Aye.
Who's that?
I second.
All right. Any opposed? Any abstentions? All right. We are now adjourned. Thank you.
Thank you.
Perfect. All right. Can I get a report out for from executive session? A careful report out.
During the executive session, the board discussed various investment matters, reviewed personnel decisions, and also made decisions about which candidates to hire. Now we need a motion to adjourn.
All right. Is there a motion to adjourn?
Motion to adjourn.
All right. Is there a second? Second. All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? We are adjourned. Thank you, guys.
Mikhail, you can turn the camera off now.
Good job.
Thank you. Okay, can we get a report out on the NYSERS executive session? Diane?
The board took action pertaining to the public equity and fixed income plans and approved investments pertaining to private equity, real estate, opportunistic fixed income, the details of which will be available upon execution of the contract.
Okay, thank you very much. Now, what we're going to do is entertain a motion to go back into executive session in NYSERS to discuss a personnel matter.
So moved.
Is there a second? Okay, all in favor of the motion to... Any discussion, sorry. All in favor of the motion to go back into executive session to discuss a personnel matter, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, so we're out of public session for NYSERS.
All right. Now we need a careful report out for from executive session.
In executive session, there was a discussion of a policy documentation matter. Implementation plans in 2 asset classes were presented and discussed. Consensus was reached, which will be announced at the appropriate time.
All right. All right. Thank you. Now we need a motion to adjourn.
So moved.
Is there a second?
Second.
All right. Any discussion? All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? Motion carries, and we are adjourned. Thank you. All right.
Back on. The camera's back on.
Okay. I'll do the report out. In executive session, we discussed a personnel matter. Can we have a motion to adjourn?
So moved.
Is there a second? Okay. Any discussion? All in favor of the motion to adjourn, please say aye. All opposed, please say nay. Any abstentions? Great. The meeting is adjourned. Thank you.